case, it just validates that point. So on to retirement income planning. So I'd like to start my discussion by sharing a recent conversation that I had with a colleague and friend about financial rules of thumb. And the conversation was mostly about how much we disliked the notion of rules of thumb and which ones we thought were the most damaging to the general public. Nearer at the top of the list for both of us was the notion of a safe withdrawal rate, the 4.5 rule of thumb. You know, a lot of times Jim and I, we hear about this rule of thumb, people ask about it, and while it's a great place to start the conversation, it's really only the tip of the iceberg when it comes to retirement income planning. Many of you on the call today are already in retirement, so much of what I'm going to discuss will sound familiar. We also have some of you who are on the call that are in the accumulation phase of life. But in either case, whether you're in retirement or not, I hope to shed some light on our process and provide a comprehensive overview of the analysis and important considerations behind the retirement income planning we do for you. So with that in mind, what I'm going to be discussing today is the safe withdrawal research and the underlying assumptions, the typical spending in retirement, spending cycle I should say, income tax planning considerations, and managing risk with regard to retirement income planning. So let's begin with the safe withdrawal assumptions. The starting point for this topic in the modern era is with William Bengen. In 1994, he famously coined the phrase safe max and the notion of a 4% withdrawal rate using historical simulations. Later research built on Bengen's work and looked at the perfect storm. The time frame that was analyzed in this later research picked the worst 30 years in the history of the U.S. stock market, basically from 1970 through 2000. As many of you may recall, the early 70s, they were a terrible time for the U.S. Investment markets. They had two back-to-back really bad years followed by a prolonged period of stagnant growth and extremely high inflation. This later research also added portfolio construction assumptions, and those assumptions included having an adequately diversified portfolio of 60% in equities, 40% in fixed income, with annual rebalancing, and it assumed 1 year of cash would be set aside. With these assumptions, the safe withdrawal rate increased to 4.5, and that seems to be where the rule of thumb has been derived. So I want to take a moment and just highlight and point out these assumptions, the underlying assumptions. They're very important to the study. And that is the initial withdrawal is 4.5% of the portfolio's balance. The annual draws never go down and they are only increased by inflation. Cash within the portfolio, cash within the portfolio is equal. The portfolio has a 60-40 split, 60% in equity and 40% in income. And the portfolio is rebalanced on an annual basis, and that 1 year worth of cash is replenished at that time. So let's take a look at an example. Here we have Mr. and Mrs. England. Their goal is to have $150,000 in retirement income. They have a $1 million portfolio. Within their portfolio, they have $600,000 in an IRA, $150,000 in a Roth IRA, and $250,000 in an after-tax account. The retirement income is comprised of Social Security being $38,000 per year, and they have pensions. They're both PERS retirees. Pension income of $67,000. So their remaining need is $45,000, or 4.5% of their portfolio. So they're all good if we use the rule of thumb. So what I'd like to do now is take a look at what happens a few years into their retirement. We can see here that we've got their $1 million. Here's their $45,000. They're left with $955,000 to invest for the year. They have a 7% rate of return or performance for the year, and at the end of the year, they end up with a little more than $1,060,000. Jump over here. So a note here is that each year they have steady inflation of 3%. We jump on over here to the second year and start the year with the $1,060,000. Their next year's withdrawal is of $45,000, but it's been inflation indexed increased. It's now $46,000, and that leaves them with just over $1 million to invest in the leave invested in the market. But look at what happens here. They have a decline of 20%. The portfolio declines by 20%, and their ending balance is now $810,000, just over. Third year, here we go. There's their withdrawal. It's indexed. Now their withdrawal rate is technically just shy of 6% of the portfolio. They have $763,000 left to invest for the year. They have another bad year. By the end of the third year, they're sitting here with just over $500,000. In the fourth year, with that just over $500,000, still experiencing inflation, their withdrawal is just under 10%. And you can see here that they're luckily they have another an up year. So by the fourth year, you know, how many people would be comfortable with this? You know, and again, this is a safe withdrawal research, and it's using the rule of thumb. So surprisingly enough, these numbers are actually taken from the study. These years here are 1971, 1970, actually this is 73, so this would be 72, 73, 74, and 75. So the problem with the rule of thumb, the criticisms that I would have, is that how well are the underlying assumptions understood when people talk about them? Also, it really adds to complexity about other planning opportunities, such as Social Security maximizing and planning. As many of you know that we earlier this month had a topic, an educational session about Social Security maximization, and that's one of the things we take a look at within your portfolio. And this rule of thumb really kind of puts a wrinkle in that, you know, largely because the rule of thumb assumes a level spending that, you know, you start with a certain amount and it's only increased for inflation. You know, what do you do if you have lump sum needs? And what happens if you underspend in future years? You know, just the main problem is that this rule of thumb really pigeonholes you.